Hello, I am Trevor McCandless with Fusion CPA. Today we're covering tax planning topics as they relate to micro acquisitions. So really glad to do this with Ryan's team and all of you. So let's dive right into it. Personally, I have a lot of fun with these topics because they are really so positively impactful to your success and really putting more money in your pocket. And let's face it, that's a big reason why you're an entrepreneur. For some background, I lead a brilliant team of CPAs over at Fusion CPA. We are a technology-forward tax accounting and advisory firm specializing in SaaS and e-commerce ventures. I started the firm in 2011, and Fusion CPA was recently listed as the only CPA firm in the Gator 100 of fastest-growing University of Florida alumni companies, so really proud of that. Quick disclosure, as always, everybody has to do it. We are covering tax planning and accounting principles at a high level, and that while I am, of course, a CPA myself, you need to engage your own CPA or Fusion CPA to give you custom advice for your specific situation. So let's dive into this conversation. We're covering a lot in a short time frame, so write down your questions and reach out to us, your CPA, again, for more info. These topics are meant to get you thinking about tax planning and the topics that may apply to you, and of course, so you can avoid a lot of missteps. So we've broken this conversation out into two sections: pre-acquisition tax planning and post-acquisition tax planning. In the first section, we're going to highlight the tax and accounting effects of entity choice, business fundamentals, operating agreements or OAs, and purchase agreements. It is unfortunately very common for us to see ventures that have not properly pre-planned their initial launches or their acquisitions. Thus, it's extremely important to nail down your investment thesis and vision prior to even officially beginning this process. So let's dive into the tax differences of each of these entity types. Single member LLCs, SMLLCs, and S corporations are the top two most common entity types for small businesses. In a small business, or rather a single member LLC, where the owner is an active operator, every dollar of net income recognized throughout the year is generally subject to the same marginal tax rates that everyone else is, and is subject to roughly an extra 15.3% of self-employment taxes, which are also known as employer and employee side Social Security and Medicare taxes. A side benefit of this entity type is that you don't have to file a separate tax return for a single member LLC. The activity is reported on your personal tax return, Form 1040, on the Schedule C. And additionally, you don't have to put yourself on a W-2 salary with a payroll company if it's just you. That's a really common question that we get a lot. And there's no need to commit to a payroll company if it's just you. So many times the administrative costs are lower for a single member LLC as opposed to an S corporation, which we'll move into now. In an S corporation, there are a few twists. First, you do need to put yourself on a reasonable salary when you are the owner of the entity and are providing personal services to the entity. Second, you'll need to file a separate tax return for an S corporation at the end of the year. Both of these slightly increase your compliance costs, and thus I don't typically recommend doing an S corporation until net income is getting to over at least $70,000 each year. There's some things you obviously have to learn to understand an S corporation. That's a time commitment for you. That, in addition to just the extra cost, let's make sure that you're saving a good amount of cash before you actually incur these costs and have to understand all the implications of an S corporation. That being said, one of the main benefits of an S corp and what makes it one of the most popular entity choices for small businesses is that the flow through net income via the Form K-1, which is one of the tax schedules coming out of an S corporation, is not subject to this 15.3% self-employment tax that single member LLCs are generally subject to. Now recall that the wages you have to pay yourself as being structured as an S corporation are subject to those 15.3% taxes. Thus, the IRS mandates that you have to put yourself on a reasonable market W-2 salary, which everyone should do a lot of research on to determine with their specific unique business where they fall in that spectrum. It's a big planning conversation, as you can imagine. In regards to what this tax savings could look like in an S corp versus a single member LLC, let's do just an easy example. Let's say the entity, its SaaS company, is netting roughly $100,000 in any given year, and then with that $100,000, you put yourself on a $70,000 salary. Remember, that's subject to the 15.3% tax. Then your tax savings is roughly $30,000, the 100 minus the 70, times 15.3%. So that's roughly $4,590 in savings. So that's a compelling savings on $100,000 of net income. So let's then compare that to partnerships and C corporations. These are more advanced entity types. We particularly like partnerships, especially when you are raising capital and need to have a creative structure for granting people and employees potentially equity over time, a common growth strategy. You can also be very creative with your profit, loss, and distribution allocations as opposed to an S corporation, which is very rigid from this perspective. In an S corporation, if you own 30% of the capital, you're required to get 30% of the profit, 30% of the loss, 30% of the distribution allocations. It's very rigid. We also like it from going back to a partnership, we also like it as a parent holding company if you're planning to have potentially a tiered entity structure down the road, maybe some subsidiary investments at some point. With each of these entity types, there's going to be upsides and downsides. On the downside for a partnership, from a tax perspective, is that most of the time, all of the profits are subject to that self-employment tax as opposed to S corporation. Self-employment tax comes up a lot in these conversations. Then we quickly move on to C corporations. They're the least common among small businesses, really due to the double taxation. Income comes in, taxed at the entity level. Then once you want to kind of pay yourself via dividends or salary, also taxed there. But they're the most common type of entity for high growth companies that are raising significant amounts of capital and really one day have eyes on going public. So choosing the entity that is right for you, really, I'm going to say this a couple times throughout this conversation, should involve both an attorney and a CPA so you get the full picture of the legal and tax and accounting ramifications of your decision. I'm always going to be suggesting to go to some professionals who have seen a lot go right and wrong and to leverage that knowledge base. Next up, business fundamentals. Now that you've nailed down the best entity for you and your vision, you really need to begin capturing all of the expenses and in short order, hopefully, revenues that will be coming in a very clean manner. The first thing, open a fresh new company bank account and credit card account if you need that. And note that your accounting team is very quickly going to need view-only access so we can link the bank accounts to whatever accounting platform you end up choosing. We love QuickBooks Online. It's kind of one of our preferred platforms. There's also very niche platforms given whatever industry that you are in. That being said, better do this now before you really get rolling because you need to focus once you get rolling your time on growing your venture. It's my recommendation to begin setting this up at least 30 days prior to launch or acquisition. I think it is very helpful on this, even this is business fundamentals. We see it go wrong very often. So I think it's helpful to share like a new client story where this did not happen. And I think it'll really hit home. So just a few weeks ago, a first-time entrepreneur came to us. He'd acquired an e-commerce company last January, but it was really 2 Januaries ago, so 19 months ago. He was completely frantic. He had transactions going through his personal PayPal as well as his personal Bank of America accounts, along with all the other regular expenses like mortgage, groceries, daycare that he just incurs as part of his daily life. Obviously, he had no formal accounting system in place. His company had grown to roughly $150K of monthly recurring revenues. he hadn't filed, another fact, he hadn't filed his 2018 tax return, but at least he was ready to rip off the Band-Aid, and it was keeping him up at night, and he knew he just had to, it was going to get worse if he didn't address this. So while it's solvable, it's now very costly to the entrepreneur. Our team has to go back and dig month to month, transaction to transaction, to recreate accounting files so we can get his tax return done. Number one, that's the first kind of fire we got to deal with to get him to stabilization. Not to mention that he wasn't doing any proactive tax planning before the end of the prior year. So very costly from that standpoint, and then also very costly from the time standpoint of the entrepreneur, because we're going to need a lot of his input in understanding these transactions and how we're going to have to classify them from a tax and accounting perspective. So this takes away from his growth abilities in his business in the short term. So by not setting up everything properly 30 days beforehand, it's going to be exponentially more expensive for him. And then, you know, not even to mention the IRS penalties for late filings, late payment, interest that can mount up. Moral of the story, let's just be proactive, rip the Band-Aid off, and life is going to be much easier and save more cash. So now that we have covered entity choice and business fundamentals, let's talk about operating and shareholder agreements real quick. So while this is mostly a legal function that your attorneys quarterback for you, you really need to have the founders, the CPA, and the attorney or whoever is drafting the agreement hop on a call with each other both before they begin drafting the agreement and after they're done drafting agreement and right before finalization. The reason being is that too often we see incomplete operating agreements, and you know, my attorney friends would, you know, laugh at this because it really happens a ridiculous amount. Because the incomplete operating agreements sometimes are just not aligned with the desired tax effects and intent of the founders, partner, shareholders. So that being said, let's highlight 4 specific areas of an OA that we commonly discuss with founders and attorneys. These are capital contributions, profit and loss allocations, and distributions. So going through an example, let's say we've got 2 entrepreneurs that decide to team up and start a partnership together and buy a SaaS company for $100,000. We'll call them Trevor and Ryan. For capital contributions, we agree that Trevor will put in $70,000 and Ryan will put in $30,000 for a 70-30 equity split. Then for profit allocations, we decide not to bring on any debt. And because Ryan is going to be running point on operations, we agree that profit split should be 50-50. Then for loss allocations, let's say our CPA and the attorney or lack thereof didn't coordinate before the deal, and we unknowingly made the loss allocations 50-50 as well to match the profit allocations. So what happens if the company loses $100,000 in year 1? Well, somebody might unintentionally be getting the short end of the stick. In this case, Trevor suffers from the lack of planning in the short term. Trevor put in $70,000, but was only able to deduct $50,000 due to the 50-50 loss allocation. This is despite all the cash having been spent in year 1. Thus, there are $20,000 in losses that Trevor really just can't use in year 1 to offset some other sources of income that Trevor might have. So what's the solution? Really, communication is everything, and try to get everybody on the same page. Now that we've knocked out OAs, let's dive into purchase agreements. So by far, the most common type of acquisition for small businesses is an asset purchase acquisition. So that's what we're going to focus on for this conversation. Generally in stock purchases, there may be many liabilities that come with the acquisition, and most small business buyers don't want to have anything to do with that. Most of the time we see stock and Section 338 purchases for transactions that are well north of $5 million. So that being said, let's look at the specific tax effects of an asset purchase. So in an asset purchase, you're going to assign values to a wide variety of assets of the company you're acquiring. Some of these assets may be immediately deducted in the year of acquisition, and some have to be amortized and deducted over periods of time, typically 15 years. Please note that tax laws change frequently. We just, at the end of this last year, had a massive tax reform that changed a lot, but there's tax changes that happen every year. So make sure your CPA double checks if there have been changes to specific treatments, especially if you're doing acquisitions all the time. And so on this slide, you'll see common intangibles, assets that have to be capitalized. Note that the values you're assigning to any non-competes and goodwill, in particular, as you see on this slide, and or consulting agreements, because those are super common, especially if you have the founder continue to work for a while, will very likely come up in your negotiations. This is due to the tax treatment for the seller. So for non-competes, note that many times the seller cares about the non-compete being as low as possible in comparison to goodwill. The reason being is that for the seller, the non-compete will likely be ordinary income, whereas goodwill will likely be capital gain to the seller. If you have a consulting agreement, we'll touch on it in just a sec. For ongoing work from the founder and maybe their team, that may be immediately deductible for you as the buyer. So that takes us to our next slide. And for the most part, these are pretty self-explanatory. You'll see that your consulting agreement can be ongoing and ordinary labor cost. Essentially, that's what it is, similar to any other 1099 contractor or W-2 employee. So after an acquisition or new venture launch, you'll simply begin putting all these operating expenses on your new debit card or your new credit card, and your accounting team will begin to feed those transactions into your financial statements. So we're getting a really clear picture of your go-forward profitability, especially important during relaunch or initial launch. And that's a good segue into phase 2 of this tax planning discussion, post-acquisition tax strategy. And I could easily spend days and weeks on this section. This is the meat of a lot of tax planning. But for purposes of this conversation, we're going to focus on really just 2 main topics: choosing your method of accounting and highlighting the passive versus active tax rules. There are 2 main methods of accounting: the cash basis method and the accrual basis method, of which the cash basis method of accounting is the more straightforward and the more common for smaller businesses, especially micro businesses. Essentially how it works is on the revenue side, as cash from clients and customers hits your bank account, it is immediately counted as revenue to you and is thus taxable in that year. Then on the expense side, as money leaves your checking and credit card accounts, they're deductible against revenues to the entity in that year. From an ease of accounting perspective, this method is it. You'll see that reflected in really your ongoing monthly bookkeeping costs. If you're using this method of accounting, it's a more straightforward method. With our client base at Fusion CPA, we do a lot of bookkeeping on both the cash and the accrual basis. So let's check out why the accrual basis is also important. So the accrual basis is more common for ventures that have outside parties such as investors and lenders for which they need monthly or quarterly financial statements. Note that we believe the accrual basis gives the most accurate picture of financial performance. Essentially, as opposed to the cash basis, on the revenue side, revenues in their accrual function are not recognized or taxable until it is truly earned, regardless of when the cash is received. For example, let's say we have a SaaS company and we receive 120,000 in purchases in November for a 12-month subscription on our platform. On the accrual basis, we would generally only recognize 20,000 in the calendar year, 10,000 in November, 10,000 in December, as revenues, and the remaining would be reported on the balance sheet as deferred revenues to be recognized in the following year. This is a timing difference, and many of the reasons why people either start with accrual if they already know that they're going to have these kind of accounting treatments or issues. You can also do this a little bit later in the company. There's just a cost associated with it in doing that conversion. And then on the expense side for accrual basis, expenses are not necessarily deducted when paid. Rather, they are deducted as incurred. A lot of times there's not much of a timing difference there, but sometimes there is. And so you really got to nitpick each of the expenses. For example, if I make a prepayment of $12,000 in November for a 12-month liability insurance policy, I can deduct only $2K in the current year, $1K November, $1K December, because the other 10 is essentially a prepaid asset that hasn't yet been incurred. So again, deciding on whether to do cash or accrual can be extremely important for tax planning, especially due to these timing differences. But at this point, we're off to the races with this venture from an accounting standpoint. So let's look at how that tax picture may change as we start new ventures or acquire new ventures. The active versus passive rules come into play specifically when we have multiple streams of income from all different kinds of work that we might be doing or investments that we participate in. When you hear active in this regard, think of companies that you are actively managing and operating. And a good kind of rule of thumb to begin that thought and that logic is if you're spending more than 500 hours a year at it. One of the downsides to active ventures is that revenues from active ventures with material participation, think 500 hours, et cetera, are generally subject to that regular marginal tax rate that everybody's subject to. But here again, we're hearing plus self-employment taxes, which are Social Security and Medicare. Note that your entity structure is also a player in this. All these tax laws and rules end up intertwining at various points, and so that's part of the job that we have to do to marry them all. One of the benefits of active ventures with losses is that these losses may be able to offset other sources of income, such as wages, dividends, etc. As for passive activities, one of the upsides is that revenues are generally not subject to self-employment taxes. Again, we hear it, but can be subject to other smaller taxes, such as the net investment income tax. One of the downsides with passive activities with losses is generally that they can only be deducted against other passive activity income. You don't lose those losses if you don't have any other passive income to offset them with, but they're suspended until other passive income activities come up in a future year or future period, or until you dispose or sell the asset or company. The active and passive tax laws, you could probably tell, are very intricate. So your CPA really needs to know your whole story, your investment thesis, and your vision, and help plan this through with you. To wrap it up, as you continue to grow and expand your investments and ownership styles, you will have a lot of these different tax principles going on, as I mentioned, and probably have ownership of each of these different types of investments and entities. So I commonly say, after going through these topics, because it can be a lot, and we're only covering a high level versus going in extremely deep on specific, multi-company situations, I kind of say, welcome to the good times, baby. We kind of do all of the planning for you, but you really need to be cognizant of these principles so that you're versed at least in asking the right questions to whoever your advisor is. That being said, well, I hope you had fun getting nerdy with me. Me and my team, we really eat this stuff up. If you ever need us, here's my contact info. Would love to hear from you.